Hi everybody, Thomas at Rebel Income here. One of the questions I've been exploring lately revolves around the quality and sustainability of a stock's dividend. While dividend payout is a great initial indicator of fundamental strength, like everything else in life, there's always more to the story. One of the reasons lists like the Dividend Aristocrats are created is because there's often a difference between whether a company is paying a dividend and whether they can sustain that dividend in the long term. Dividend aristocrats are interesting because they're the stocks that have not only maintained their dividend, but have also increased their dividend payout every year for the past 25 years. The stock I'm spotlighting in today's video is Verizon Communications. They're a company that's just outside the Dividend Aristocrats list because they've been increasing their dividend every year for the past 20 years, so they still have 5 more to go. Lately, though, the ratio of dividends paid relative to earnings, which is also known as the dividend payout ratio, has also been increasing to levels that make the sustainability of their dividend as it stands an open question. A secondary question for a bargain hunting investor like me is also whether the stock's current price represents a useful value. Before we dive into the details, I want to take just a minute to invite you to check out my Rebel Income Patreon page. I publish daily exclusive access content on this page, from stock reports detailing my analysis and search for the trades I publish for my trade alerts, to lists of underpriced dividend-paying stocks, and even weekly recordings discussing current open trading positions as well as current market conditions. You'll find the link in the description area for this video. Take a look. I know you'll find something that you'll be able to use in your own trades. Verizon had been following a long-term downward trend through most of 2023. It bottomed in October at around $30.50 per share. From that point, the 200-day moving average has started to flatten out, which could be an indication that downward trend is slowing. That flattening of the 200-day moving average is certainly a reflection of the acceleration of the stock's bullish momentum, which we can see as the stock bounced off of that low and has created a new short-term upward trend that has the stock now pushing a little bit above $42 as of today's market close. That also mirrors the upward movement of the 20-day moving average. The stock has also gapped up higher following the latest earnings report on an overnight basis. It went from a little below $40 all the way to above $41 overnight just a few days ago earlier this week. All of this is a really strong indication that bullish momentum in the stock is increasing. Another bullish indication is the fact this week's bullish activity has pushed the stock above resistance at around $42. That's a really ugly line, I apologize. But resistance at about $42 from pivot lows that were last seen at the beginning of 2023. That puts current support at about $42, with the stock at about $42.50 right now, and likely expected resistance at around $44. The basis for that is the last peak that we saw beginning of January at around $40 per share. That gives about $2 of room between 40 and 42. So with the stock now moving up above 42 to about 42.50, there should be upside to about $44 per share right now. That means that if you're trying to look at this stock in terms of reward to risk for some kind of a short-term trading opportunity, there's about $1.50 of upside against 50 cents of downside. That translates to a reward to risk ratio of 3 to 1, which is actually very attractive right now. Again, that could make the stock look very, very interesting if you're interested in placing a short-term trade. That doesn't say anything about whether or not it's a good value, of course, or anything about the sustainability of the dividend. For that, we really need to dive into the fundamentals. So let's go ahead. Over the past year, free cash flow has been increasing pretty nicely from a little over $14 billion 12 months ago to its current level at $16.3 billion at the last earnings report. That's a positive indication. However, there are some counters to that positive pattern that are worth paying attention to. For example, 12 months ago, cash was around $3.8 billion, and it has declined since then to a little over $2 billion. More importantly, after peaking at about $6.2 billion 9 months ago, the stock has seen 2 consistent quarters of declines to $5.5 billion and then again to the current level at around $2 billion. That's a pattern of declining liquidity that implies their financial flexibility is not what it used to be. At least some of that pattern can be explained by the decline in long-term debt. We can see that a year ago, long-term debt was over $162 billion and has declined over the last year by about $4.5 billion. That's also a generally positive pattern. However, Verizon is very highly leveraged. That's a very high amount of debt. The more alarming pattern comes when you take a look at the company's operating profile. I like to look at net income relative to revenues for this evaluation. Over the last 12 months, net income was about 8.67% of revenues, but it declined in the last quarter very sharply by about 16% to negative 7.7% in the most recent quarter. That's a very sharp turn to the downside, and even more alarming is the fact that it fell into negative territory. It's a strong indication, along with the deterioration of cash, that the company is spending more money than they're making and are therefore not operating as efficiently as they should. All of these metrics together start to paint a picture about whether or not the company's dividend should be sustainable. Now, one of the things that we have to factor in here to leaven the evaluation is to understand the cyclicality of the markets. Sometimes companies will experience quarterly declines, sometimes even over a period of months, period of quarters, that they simply need to be able to weather. Companies in many of those cases won't decrease their dividend payout. They'll simply concentrate on being able to weather the storm and continue to pay a steady dividend to their shareholders. This isn't automatically an indication that they are going to cut their dividend. It does, however, start to bring it into question. Let's take a look at a couple of other things. Verizon does pay a very attractive dividend at the stock's current price. We can see that their dividend translates to a dividend yield a little above 6% per year. That's very attractive and something that has certainly brought a lot of investors to the table simply for the dividend alone. In the past, I've read a lot of analyst reports that have suggested that telecommunication companies like AT&T, Verizon, and others can serve as a substitute for bonds, considering their higher than normal levels of yield and their relatively stable businesses. In the case of Verizon, the additional question comes in when you consider how much of their earnings is being taken up by their dividend. In order to be sustainable, the general assumption is that lower dividend payout ratios are better than high. For myself, I usually prefer to see a dividend payout ratio of about 50%. In the case of Verizon, we can see their dividend payout ratio is above 95%. In other words, just about every single penny of earnings that the company is making right now are going to service their dividend. That is an automatic warning sign that should raise the question of whether or not Verizon's dividend is sustainable. Now, I mentioned just a minute ago that a lot of companies may experience some cyclical downturns and difficulties and simply choose to weather them and continue to pay their dividends at their normal levels. We can see that that is pretty much the case for Verizon. Remember that a lot of the patterns that we're seeing to the downside in terms of deteriorating cash net income are patterns that have emerged over the past year, and yet the company has continued to maintain not only their dividend but also the pace of their dividend increases for each of the last 5 years that we can see on this chart. As I mentioned, they have a pattern of increasing dividends that goes back 20 years so far. Each of these increases that happened in the last quarter of the year are approximately the same size, which implies a level of consistency that management is actively choosing to maintain. That is a positive indicator that suggests that even with the current difficulties, the company is likely to be able to maintain their dividend. Whether or not they will be able to continue to raise it is still an open question, but I would be surprised to see the dividend actually decrease. The final question to consider is whether or not the stock represents an interesting value at the current price. We've already talked about the upward trend the stock has been following for the past few months. That in many cases will push a stock past the level of being an attractive value. However, in the case of Verizon, with the stock a little bit above $42, as we can see, it still has a fair value target price a little above $51 per share, suggesting that there is about 21.25% upside in the stock from its current price. That's pretty attractive. Again, considering the expectation they should probably be able to maintain their dividend, that makes Verizon a stock that's worth continuing to pay attention to. Thanks everybody for your time. I hope this has been useful. As always, if you like my content, please go ahead and click here to subscribe to my channel so you can get notifications about each new video I publish. You can also click here to check out another video that's a good example of the kind of content that you'll see on my channel on a regular basis. Thanks everybody. This is Thomas at Rebel Income. Talk to you again soon.